Imagine waking up tomorrow morning and discovering that mortgage rates are rising, even though the Federal Reserve has just announced an interest rate cut. Stocks begin falling. Businesses delay investments. Buying a home becomes even more difficult. Most people would blame inflation, politicians, or the Federal Reserve. But what if the real reason isn't in Washington at all? What if the story actually begins nearly 7,000 miles away, after in Japan? For more than 30 years, Japan quietly helped create an ocean of cheap money that flowed across the global economy, not because it wanted to support America, but because its own economy became trapped in a decades-long slowdown. Now that era is coming to an end, and the consequences could affect everything, from your mortgage to your retirement account. This is the hidden financial story that almost nobody is talking about. To understand why Japan matters so much, we have to go back to the early 1990s. At that time, Japan was one of the richest economies in the world. Property prices were soaring. The stock market was booming. Many people believed prices would continue rising forever, but bubbles always burst. Japan's real estate market collapsed. Its stock market crashed. Economic growth slowed dramatically. For years, businesses stopped expanding. Consumers spent less money. Wages barely increased. Inflation almost disappeared. Economists later called this period the lost decades. To revive the economy, the Bank of Japan tried something extraordinary. It reduced interest rates again and again, until borrowing money became almost free. Eventually, interest rates stayed close to zero for years. Later, they even became negative. In simple terms, money in Japan became incredibly cheap to borrow. Now imagine you're managing billions of dollars for a pension fund or an insurance company. Would you invest in Japanese government bonds earning almost nothing? Probably not. Instead, you would search for countries offering higher returns. And that's exactly what Japanese investors did. They invested in U.S. Treasury bonds, corporate bonds, real estate, technology companies. Money quietly flowed out of Japan and into financial markets around the world. Over time, Japan became one of the world's largest international investors. Most people never noticed, but global markets certainly did. This created one of the most important financial strategies in modern history. Investors borrowed money cheaply in Japan, converted it into other currencies, and invested where returns were higher. This became known as the yen carry trade, as long as Japanese interest rates stayed extremely low. The strategy worked, and it kept trillions of dollars moving through global markets. That cheap money helped support investments in stocks, real estate, government bonds, and businesses across the world. Then something changed. After decades of low inflation, prices in Japan finally started rising again. The Bank of Japan began increasing interest rates. Government bond yields moved higher. Borrowing money was no longer almost free. Suddenly, the numbers no longer looked as attractive. Many investors began bringing their money back home. Economists call this process capital repatriation. At first glance, that might sound like Japan's problem, but it quickly becomes everyone else's problem. For decades, Japan had been one of the largest buyers of U.S. government debt. If one of those major buyers starts purchasing less, the United States must attract new investors. And usually, that requires offering higher yields. It's simply supply and demand. Lower demand means higher interest rates. Here's why that matters. The Federal Reserve mainly controls short-term interest rates, but long-term Treasury yields depend heavily on market demand. That means the Fed can lower its policy rate, while long-term borrowing costs remain high. Those long-term rates influence almost everything: mortgage rates, business loans, car financing, corporate borrowing, even stock market valuations. Higher borrowing costs make homes less affordable. Businesses invest less. Consumers spend less, and investors often become more cautious. One quiet policy decision in Japan, it can ripple through financial markets around the world. Does this guarantee a financial crisis? No. Markets adapt, new buyers appear, governments respond, central banks adjust policy, but ignoring these changes would also be a mistake, because today's financial system is deeply connected. Money doesn't recognize borders. It moves wherever opportunities exist. The biggest financial stories rarely begin with dramatic headlines. Sometimes they begin with a quiet policy meeting. inside a cent.